So if you're a property investor using trust to build your property portfolio, Macquarie Bank just changed the game. Or did they? Their October 31st trust lending freeze has investors asking, is this a market-wide crackdown or just one bank cleaning up? Today, we're cutting through the noise with Callum, our Lord of Lending from Dashdot Finance, who's back after our popular Portfolio That Pays for Itself episode a couple of months ago. He's been working directly with lenders since this announcement dropped, and he's got the insights that you need to hear. By the end, you'll know exactly why this happened, whether other banks will follow, and the steps you can take to keep growing your portfolio regardless. So let's get into it. Callum, lots of people asking questions this week. What's going on with Macquarie?
Yeah, well, guys, you heard it here first. The Australian residential property market is dead. And what we're going to be talking about in this episode is we're pivoting to other asset classes. So maybe Pokemon cards, maybe tulips. Yes, tulips.
Yep. I've heard the tulips.
Yeah.
The tulips are back, man. Tulips are back. Yeah.
Stop trying to make tulips happen.
Yeah, property investing's over. It doesn't work anymore, does it? Like the whole Macquarie just completely killed it, didn't they?
No, it's certainly a storm in a teacup. You know, it's not a static environment. You know, banks having particular policies on what they do and what they don't do. Whilst Macquarie have made some changes based off, you know, their requirements and maybe some credit risk they identified, like other lenders are certainly business as usual. And you know, if we wound the clock back 3 years, it would be an entirely different set of lenders that were open for business for this type of lending and lenders that weren't open for business for this type of lending. So it's nothing to get too concerned about.
Let's take a little step back, zoom out, and kind of like reframe everything a little bit. So Macquarie in the last week or so announced that they were going to stop mortgage lending in trusts wholesale. They were going to stop doing it for any trust at all whatsoever. Now, the reason that this caused concern amongst property investors is because what has become more popular or more well-known over the last couple of years or few years is the idea that property investors can extend borrowing capacity if they are intelligent with the usage of structures and lenders and all of that kind of stuff. And so it has started to become a little bit of a hack. And let's just say some people on the internet became pretty aggressive in promoting that idea. And so it became started to become almost a meme in the sense that everyone started to think that's the truth, the right, and the way. And the fact of the matter is, it still is a very, very important part of every property investment strategy. But the other part of the piece of the puzzle here is that traditionally in Australia, we've had the big four banks, which are CommBank, ANZ, NAB, and Westpac. Macquarie have aggressively sought to capture market share of the mortgage lending space. It's a very huge market. And, you know, I'm obviously, this is my opinion only because I have no idea what their corporate strategy actually is, but it appears as though part of their corporate strategy to gain more market share on the mortgage lending space was to kind of, let's just say, relax some of their policies or have a high degree of tolerance for wanting to capture that market share, which included probably some, let's just call them a little loose policies as they related to lending and trusts, which probably did get exploited a little bit too much by property investors. And so what it feels like to me, and Callum, I'd love your opinion on this, what it feels like to me is that Macquarie have probably gotten a bit out over their skis. They've probably realized that actually in their pursuit of capturing market share, they may have actually taken on a little too much risk for their internal risk profile. And so they've decided to adjust their policy and their reference point for that so they can still look like the good guys. So they look like they're doing the right thing and everything like that is to look externally and say, oh, look at all of these kind of finfluencers and stuff who are saying that they can do this. We want to be the good guy. We want to reduce risk. We think they're being risky. And so what we're going to do is we're going to change our policy. Whereas in fact, internally, they probably just overexposed their book to a certain risk profile. What do you think about that?
It's definitely true. When they came to market with the change in policy that allowed these circumstances to occur, they identified that there was no difference in the delinquency on their book between loans in personal name, loans in trust, clients with loans in multiple trusts. That was the premise for it initially. And they're a bank that really thrive on efficiency. So they're always looking at ways that they can make their loan application process and their approval times more streamlined. So that's where they initially came to it from. I just don't think they were quite ready for the tide of mortgage brokers exploiting some of the nuances to their policy that really allowed for pretty aggressive borrowing power in multiple trusts. But if we think about Macquarie's brand, like historically Macquarie are a professional services business. Like that's, you know, if you look at their structure in terms of commercial lending, you know, the way their credit policies line, it's all for professional services. And it was only really maybe 3 or 4 years ago that they started to diversify a little bit more into, you know, trade-based industries, aligning some of their credit policies with it as well. So it almost seems to me that they've changed policies and they've attracted a whole heap of new business and aggressively attracted a whole heap of new business they weren't quite ready for. And I don't think it's anything to be concerned about. I'm sure they will come back to the space, given that you know, at their core, they're a professional services-based lender. They will have to lend to trusts in the future. It's just going to take them a little bit of time to work out, okay, what is actually our stance on it from a credit perspective? What are we comfortable with? What are we not comfortable with? And they'll probably come back to market with, you know, some standard vanilla policy like all other banks have for lending in trusts.
Yeah.
I find these situations really interesting because it's important to not emotionally react too much. Like I think a lot of property investors, particularly, you know, we have a lot of clients that use trusts, and a lot of people, again, probably last 12 months have been thinking more about using trusts to help with their borrowing capacity and things over the past little while. And so it's easy to hear something like this and start to panic a bit, thinking, okay, what does that mean for everyone else? Or like, what does that mean for my strategy? And I think it's interesting with this to make sure that we're zooming out and assessing the whole landscape and think through breaking down why they've come to this situation, what is the role of the different players in here. And I think it is very interesting to actually look at the Macquarie story. Now, I'm not saying that it's all Macquarie. I'm sure that, you know, we don't talk about unlimited borrowing capacity and stuff on this show, but like other people online do talk about that kind of thing as it relates to trust. So I'm sure that there's been some influence from influencers and people online talking about these kind of strategies that has influenced it. But I do not think it's the whole story. I think considering what we just talked through, like Macquarie's growth rate, I think a report just came out yesterday where in September alone, their loan book grew by 2.13% in 1 month. So their growth rate has been enormous, particularly the last 12 months. And I think to what both of you guys have said, it's just they've gotten a little over their skis and they're trying to kind of like stabilize. I do think the influencer narrative is convenient. I'm not completely discrediting it, but I think it matches up in the timing of it.
I'd be very surprised mirroring that, Gabby, if it didn't come from credit and risk first, and then the influencer spin. It's like it's very easy to make that an external factor. I think the bit that's been different. Yeah, exactly. And I think the bit that's been different is so banks will try and control the flow of trust-based loan applications they receive quite actively very often. But the way that they normally do it is on the pricing front. So we've seen ANZ, for example, they'll just price themselves out of trust loans. So they don't say we're not doing trust loans, but they just actively control them not receiving any on the pricing front. So it's just been a bit of a bold move.
Pricing, what do you mean? You mean interest rates?
Yeah. So they'll charge rate loadings for trust-based loans versus personal name, and that comes and goes through time. We've seen NAB do the same thing. We've seen Westpac do the same thing. So it's just that Macquarie being bold and saying we are not doing it versus other lenders might just say we're removing all pricing discretion on trust-based loans so they'll get no traffic.
Yeah. I think like PR is a really interesting thing, right? Because if Macquarie had just changed their policy and didn't do a big PR spin on this, then probably no one would be talking about it because kind of to your point earlier, like banking policies change all the time. Like they're constantly reviewing and changing and offering different products. I think last I checked, there was something like 4,000 individual loan products in Australia or something like that. Don't quote me on that figure. There's lots of different loan products with lots of different conditions. There are lots of different lenders, and those lenders are constantly changing their position and their tolerance on a variety of different things. And so if Macquarie just stopped lending into trusts and just changed their policy and didn't say anything about it, it probably wouldn't really be a big story. Because the fact of the matter is, there are still plenty of lenders who are still lending in trusts, and strategically, I think that's going to continue to happen over time. Like maybe there'll be some more scrutiny on it or whatever, but also from an investor perspective, it's very easy for these kind of news stories to kind of really get blown way out of proportion, right? Mm-hmm. Property investors are always looking for something that is going to go wrong. Like I remember a few years ago when the serviceability buffer was increased from 2.5% to 3%, investors were like, "Oh my God, this is going to be..." What happened after that? Property prices continued to go up. Like, who cares? Everyone just kept buying. Interest rates went up. Oh my God, that's going to be the worst thing ever. Property prices continued to go up. People kept buying. So these things happen, and they're going to continue to happen. I mean, when we started Dashdot in during the time they're doing the Royal Commission into banking. So there was like lots of red tape in the mortgage space. Then in that same year, there was an election where they were talking about scrapping negative gearing, and then look, there's always something. And so I tend to think that this is much more PR than it is anything else, because, and Callum, I'd love your take on this, but like, there's plenty of other banks and lenders out there that are still lending into trust. Like, so from a strategic perspective, has anything changed, or is it just that like one lender has gone off the boil for a little while?
Yeah, exactly that. I mean, look, Macquarie, we're a favoured lender, certainly. The interest rates are good, the process is very streamlined, but if you're a property investor out there, regardless of where you are in your journey, it doesn't really change the outcomes. It just means there's one less lender that we could potentially be looking to use. And I think, some of the more experienced property investors in the room here would know, mirroring what you said there, Goose, it waxes and wanes, and there's always different challenges that you have throughout your investment journey, whether that's on the lending front, whether that's on the property front. It just really highlights the value of having the right team in your corner to navigate through those challenges, because you can't expect static environmental conditions for you to build your portfolio. There's always minor adjustments that you need to make through time to push to that next level. And this is just another one of those.
Yeah. Go, Gabby. You go. Yep.
No, you go.
Okay, I'll go. Yeah, I was going to say it's a really good point about having the team in your corner, because if you're out there just trying to do this on your own, and because products and policies and stuff are changing all the time, you can't. Yeah. Like if you're trying to do this on your own, let's say a few months ago you heard that if you had a trust and you went to Macquarie, then you could do this hack. Maybe you watched a YouTube video where someone talked about getting unlimited borrowing capacity or whatever. And if that was your whole point of view and you were trying to do it yourself, and then all of a sudden Macquarie said, "We're not doing that anymore," you would probably assume that entire strategy, which forms a part of a broader finance and property investing strategy. It is not the strategy. It's not like the single thing. It's part of a broader strategy. But if you were trying to do that yourself, you'd probably be really stumped, and you'd be like, "Oh my God, maybe I can't invest in property." Whereas in fact, actually, if you just understand what lenders have got, what tolerances, what policies, what behaviors, what appetite at any given point in time, you know how to navigate that. And that's the benefit of having a team around you. I just did a little bit of research here as well. And Callum, I'm happy for you to refute this, because you actually might know. You might know better. But I just tried to search for how many mortgage lenders are there in Australia, both bank and non-bank. And I got a number that said there are potentially up to 600 bank and non-bank lenders in Australia. Like there's 100 kind of like main ones, but then there's up to 600 that were offering lending products. Does that kind of sound about right?
Look, if you included commercial lending, mortgage managers, white label products, certainly it probably would be amongst that level.
Okay, but at the core, there's probably more like 100 kind of core lenders. Is that probably?
Yeah, and even sub-core, 30 to 40 realistically, that probably 95% of the market's mortgages are with.
Mm-hmm.
Okay, so if someone has spent the last few months putting together their trust, like they're like, "All right, cool, I get this, I understand the strategy." They watched our episode a few months ago around how to build a property portfolio that can pay for itself, and they went, "Aha, it all clicks. It finally answers all these questions." And they've spent the last few months creating trusts and getting all set up for it. They've created the companies, they've refinanced equity, they're ready to go, and now they're sitting there going, "Oh my God, is that entire strategy out the window? Have I just wasted months?" What would you say to someone like that? How do they move forward?
Yeah, it's a really good question, and I could certainly understand from clients that have been speaking with their broker about Macquarie as a lender of choice, and then all of a sudden they're not lending anymore. But no, the initial strategy that you arrived at is still the correct one. It really is just as simple as signing a loan application form with Commonwealth Bank on it instead of Macquarie Bank. And it's worthwhile remembering too, it's like it really doesn't matter who is lending you the money, as long as they're lending it to you a rate of interest that allows you to move to your goals, to your next goal. Like, that's all that really matters. So I wouldn't be too concerned about that if I was in that position.
And so we were talking just before we went live, you were talking about the fact that one of the, because of Macquarie's, let's call them pretty loose policies, they were allowing individuals to get multiple loans in multiple trusts with the same lender. And that's sort of what they call like a look through, where they say like, are we looking across different? And they may have like, I might go to Macquarie and I might set up a trust, buy a house, and then with Macquarie set up another trust and buy a house. And they were kind of just ignoring the fact that they already had a loan with me with one trust with one house. They were ignoring that fact and allowing people to have multiple trusts with the same lender, the same individual, the same. And that was the bit that was a little kind of weird, because most other lenders are happy to do it, but it's more like the strategy requires you to have multiple lenders with multiple trusts. Do you want to expand on that? Do you want to just explain that a little bit further?
Yeah. The way you explained it there was correct. So that was the differentiating factor there. So they were applying that methodology on their own debts effectively. So they were relying on a client declaration to basically suggest, okay, this trust number one, which we just purchased the property with Macquarie in, it's able to meet its own commitments, and we won't even expense anything to do with that trust in this next trust application that you may be undertaking. Now, other banks are different in the respect of, provided that another bank's debts in a different trust are confirmed to be profitable, they're happy to leave them out of the borrowing power calculations. Other lenders out there aren't happy to effectively ignore their own debts. And you can imagine from the bank's perspective, it's like, well, we can pretty clearly see that this trust over here that we just settled is not actually cash flow positive. And, through time, it would start to become very evident in the credit department. Well, hang on, what are we doing here? We're effectively overexposing ourselves, to certain clients. And I think the thing to remember is that, I'm sure there was a very small minority of mortgage brokers or clients that were really taking drastic advantage of this. And I'm sure some of them, may have overextended themselves. So I'm sure there is some degree of truth to why Macquarie needed to do this, because it really was under the right circumstances a license to borrow unlimited money, which, that's not a good thing, right? It can certainly lead to some negative outcomes. So
totally, it's certainly not sustainable. That's for sure.
Yeah.
Okay, so how do you think this is going to affect, like, what do you think the second order effects of this are? Any? Like, are you just literally like, I don't care, move on, like it changes nothing? Or does this change anything? How do you think this changes, people's approach to lending? How do you think this changes? Do you think there's any second order effects of this for property investors, the property market? Talk to us about that.
Yeah, well, the second order effects, we see this, in all facets of the mortgage industry. If we see a key player pull out of a particular space, within a short period of time, another player will see that as free market space that they can then occupy. So we will definitely see some other lenders say, okay, well, one of the biggest players is out of the market. Let's modify some of our policies to try and soak up some of that market. So in terms of like an overall market conditions, if we fast forward, a month or two, you will still have the same bevy of options. It'll just be a different lender that soaked up that traffic instead of Macquarie. So it'll be business as usual, honestly, once we've got through this small hump of, people being frustrated that maybe they had an in-process loan application with Macquarie, or they've got all their lending with Macquarie and they wanted to go back to Macquarie and they can't. Like, once we get over that, it's just going to be BAU.
So
yeah, because it's
you go, Gabby.
No, because it's like this is a Macquarie siloed decision, right? So they, as a business, decided it's too much risk for us, but it doesn't mean the demand is not there. So you're right. Like, somebody else is going to come along. The demand is still there. They're going to soak that up from what Macquarie left. Would you say then, because it's mostly Macquarie, like there doesn't seem to be much risk? I mean, we don't know, but much risk in other lenders applying this as well? Because I think this is a I've seen like canary in the coal mine mentioned, like this is a signal for like everything's going to hit the fan, or other lenders are going to apply these kind of strategies. Do you think there's risk of that happening?
I think I would be pretty confident we'll never see someone take the exact same stances as Macquarie again. But in terms of like general lender appetite for loans in trusts, a level of satisfaction with accountants' letters confirming that other trusts are profitable, like I can't see that disappearing. And the other thing on that front too is that, you know, over the last 3 years, there's been various different lenders that have come in and out of that space at different times. Like Commonwealth Bank at the moment, very open for business, provided other trusts are profitable, but 6 months ago they weren't. So it's just this fluid dynamic that happens through time. Lenders occupy space, and then for whatever reason they decide maybe it's a credit decision, maybe it's a risk decision, maybe it can be a delivery issue. Trust loans are more complex and they take too long. Maybe the lender decides we don't want to do that at the moment because we're harming the traffic that we're getting for simple PAYG loans that we think we can make more money on. So there's so many factors that influence whether a bank is occupying that space rather than just what we've seen with Macquarie, and that will just continue through time. So, but I guess the point of it is there is still demand for that, and it's still a strategy that plenty of property investors are using. So it's not going anywhere.
It also probably adds more weight to the fact that the PR spin is probably virtue signaling from Macquarie, to probably appease their board and shareholders and all of this other kind of stuff, because they probably, they took too much risk, but then they can position themselves as being like they're the ones that are being safe, they're the ones that are being like low risk, when actually, in fact, they probably went too hard. So, just one point on this. So, for people that have already got loans with Macquarie, it doesn't affect their current loans, right? It doesn't change there. Before you answer that, by the way, if you have any questions for Callum, if you have any questions about this topic, drop them in the chat. It's a great opportunity for you guys to ask direct questions. If you've got questions about lending, how this works for you, how this applies, any of this kind of stuff, what Callum's favorite flavor of yogurt is, whatever it is that you want.
Or if you're not here live, if you're watching the replay, leave a comment as well. I will wrangle Callum to get answers out as well. Yeah. So Callum, I haven't told you that. Great
point. The last couple of videos, there's been some really great comments left on the videos, and we've been going through them and responding to those questions. So if you aren't here live, if you can't make it live, please make yourself known in the YouTube comments, because we will get back to you. We do try and respond to everyone, even if it is just a hello. But this, just back to the point that I was making. So this doesn't affect any of the current loans. So if you've currently got a loan with Macquarie, let's say you've got 3 loans with Macquarie or something like that, it doesn't affect any of your existing loans, does it? It only affects new loans. Is that correct?
Yeah, it's an interesting point. So I've had some feedback from some senior figures at Macquarie that they will be open for business for equity releases of existing trust loans, for example. So that's the tricky part right now. So if you wanted to do an equity release on an existing loan in a trust with Macquarie, you can't do it. But that will be the part that they're more likely to bring back to market first, because obviously, that these loans are just going to run off the book if clients can't do equity releases on them. So that is the scenario that could specifically be challenging for someone right at this point in time with Macquarie loans. But I would be pretty confident that'll be resolved soon, because it would be pretty challenging for them to see all these loans that they settled, 6 months ago, especially clients like ours, where, they've had seen a massive amount of growth, to not be able to access that equity.
Yep. 100%. Okay. So that's good. That kind of covers that off. What else do we think people need to know about this topic?
Yeah, well, I might just cover off on some questions here that are sort of related, in the chat here. So Dennis Jang, have you heard of the strategy where some lenders lay to keep a property in your personal name and can refinance the loan into a trust? Which it's an interesting strategy, and if we're talking about influencers, I've seen this one being passed around a bit online recently too. So this is something that you can do, but you can only do it with a very small handful of lenders: Commonwealth Bank, Westpac, and some non-banks. So it's a strategy that can be applied to clear up the level of debt that you have on your personal balance sheet. But the thing is, there's a whole range of accounting type questions that you'll need to understand, because you're changing the ownership of the debt. But under the right circumstances, yes, you can refinance debt that belongs to you personally into some sort of corporate borrower, but you're also pigeonholing yourself to a couple of lenders only that you always have to have loans with, because it's not an acceptable loan structure to the majority lenders out there. And you do see some people, for example, doing this with their principal place of residence and then getting some sort of lease back agreement in place so they can confirm profitability. I won't go too far down that rabbit hole, but that's something that can be achieved with your accountant.
Really, honestly, that's a new one to me. So people are able to say they own a property, maybe a PPR, for example, in a personal name. They've got a mortgage in their personal name, but then they manage to transfer the loan into a trust without changing the. That's kind of weird because a company is, you know, a person basically, right? By definition. So a company is a person, and if a company ends up owning the debt, so the company has got debt on an asset that it doesn't own because it is owned by another person.
Has to have common directors and shareholders is the thing. They say, well, this is still your asset effectively, and this is your company that you're choosing to borrow against a personal asset. And if we think about that type of debt structure in commercial lending, that's very common. For example, let's say, Goose, you decide you want to buy a factory or something. You may have a corporate borrower linked to your house. You've taken an equity release to buy a commercial property. It's just not so commonplace in residential loans.
Yeah. So, okay, fair enough. And do you have an answer to the question of like, where would you deduct the interest? Because that's an interesting question. Not financial. None of this is personal financial advice. We are not accountants. We're not licensed to give financial advice. If you're watching something on the internet, by definition, it can't be personal. So this is just conjecture. But where in principle, where would the interest get deducted from?
Yeah, look, that's probably going a bit far down the rabbit hole in terms of accounting questions.
Just for everyone's benefit, Callum said to me, he's like, how many questions are you going to ask me that could get me in trouble today, Goose? And I said, if you don't want to answer them, you don't have to answer them. So I think
all of them.
The response I would make to that is, if this is something that you're thinking about and you need the right accountant to help you step through how it might work from a tax perspective, that's really where it starts. And we can connect you with an accountant that is familiar in this strategy and how you can ensure that you can still claim some sort of deductibility for that debt.
So there's some random people in the chat who are suggesting that perhaps the interest deductibility might be in the trust, but we don't know that. We wouldn't know that. You would have to go and speak to an accountant to work that out. Okay, what else you got, Callum?
Well, I mean, we've got Sean's spammy questions here, but we can step past.
Let's ignore Sean. He's a menace.
Why don't you do some work, Sean?
Yeah, Sean, you go back to work.
You've been on a long lunch break, mate.
Yeah.
Comments.
Yeah. Okay, so all right, let me just ask a question. Do we feel like we've satisfactorily covered off the Macquarie Trust lending issue? Like, do we feel like we've satisfactorily let me just finish my little rant, Gabby, and then because it sounds like you got something. Do we feel like we've satisfactorily covered off the Macquarie Trust issue? Do we feel like we've satisfactorily helped investors who are feeling concerned that there might be some big seismic shift happening in a property market, realize there isn't? How do we feel like we've satisfactorily given property investors optics on what they can do instead, and that Macquarie is just one lender and that the process continues? Do we feel like we've ticked off those boxes?
Not yet.
I mean, yeah, right. I'm interested to hear Gabby's thread here.
Go, Gabby.
Well, I just want to know. I know a lot of our community are very strategic, right? Even the comments that come through in the chat right now, it's about strategy. And I think it's all well and good for us to say, look, it's probably not going to expand to other lenders and blah, blah, blah. But let's say that it did. Yeah. Let's say that this strategy became a non-strategy. Are there other strategies that people should be thinking about so that they don't get stuck, that they can keep investing?
Yeah, it's a good question. So I think to expand on that a little bit more, and I really don't think this is likely, but what we would see, let's say there was some sort of regulatory pressure in relation to this sort of stuff, right?
Yeah.
You might see the major banks start to tighten up and, maybe they become a little bit more restrictive, but what would take a long time to happen, if ever, would be the non-bank lenders in Australia resisting something like this. That they don't have the same regulatory pressure as the banks do, and we'd be very likely to see them still maintain policies that allow this sort of stuff. And if we think about like a lot of the sort of macro changes that have happened in the lending landscape, banks will say, we're not doing that anymore. The regulatory pressure on this is too tough. And then the non-banks just soak it all up, like self-managed super fund lending at the moment. not done by the banks, hasn't been for a few years, but the non-banks still lap it up. So I really couldn't imagine a scenario where non-banks aren't open for business for that sort of stuff. And then let's imagine if that did happen, self-managed super fund is still something, self-owned super funds is still something that allows you to drastically push the limits of your borrowing power under the right circumstances. It's just difficult to look into a crystal ball and know what the response would be in that circumstance.
Yeah, for sure. But effectively, we have these tools available to us, right? It's a game of finance, and we're just constantly adapting to what chess pieces are on the table, right? And if one goes, you adapt your strategy and you figure it out. But yeah, we can't really predict what's going to happen. Yeah.
And that could be the shift into tulips, to be fair.
Gabby, but I think your point's really, really important. Like, in general, real estate investing is extremely dynamic. Markets are continuing to change, strategies change, lending policies change, all kinds of things continue to change. It's really, yes, Gabby?
I was just going to say, and let's be real, that it can be frustrating. It can be annoying, and it takes time and effort to stay on top of this and constantly dynamic, but it's kind of, it is what it is to some degree, the dynamicism.
Yeah, I mean, yes and no. I mean, find an asset class anywhere in the world that doesn't have dynamic nature. Now, on the one hand, it's highly dynamic, and on the other hand, if you just bought a property and did nothing for 30 years, you'd probably be fine, right? So it can be something that you just buy and forget about it and build wealth, right? So it doesn't have to be dynamic. It can actually be, if all you do is just buy a property and do nothing, then by definition it's probably going to be pretty low, low dynamism. But pragmatically, things are always changing. Demand is moving between different markets, as we covered last week or the week before. The market structure is changing. The whole market is becoming more financialized. There's different correlations, different drivers, there's all these different things, and that will continue to be the case. Property investing 20 years ago is different from property investing 10 years ago, which is different from property investing 5 years ago, which is different from property investing today. And so as a property investor, you should reasonably expect that conditions are going to continue to change. Interest rates might go up, interest rates might come down, immigration might go up, immigration might come down, building approvals and completions might go up, building approvals and completions might come down. APRA might crack down on a certain thing. There might be a Royal Commission into banking. There could be, who knows? There could be all kinds of different things. But the one thing that's very consistent and constant is that if you can navigate through that dynamic nature, you continue to build wealth in real estate. It is the unstoppable force of wealth creation in Australia. And so if you're able to recognize that it is dynamic, and you shouldn't go into it with a static mindset, assuming that it's all just cookie cutter, clip this, paste it there, done, that it is necessarily dynamic, then you're going to do a lot better, and you're going to build a lot more wealth a lot faster than if you just assume that it's going to be static. So I think it's a very important mindset point for everyone to have, because everyone thinks, oh, it's bricks and mortar, it just sits there and does nothing. It's like, well, sure, but markets continue to change a lot. Like my auntie and uncle, they live in Boyne Island in Gladstone, and they were my they were always considered like the wealthy auntie and uncle, right? They bought a really nice house. When I was a kid, I felt like it was a mansion, and they bought that in, I'm going to say 2011 or something. I don't know, maybe whenever they bought it, right? Whenever they bought it, maybe it was, and it was worth a lot of money. And then the market tanked for 15 years or whatever, right? Or whatever it was, 12 years. And so they were basically underwater for a really long period of time. Now it's come good now, so great. Hey, rock and roll. But the fact of the matter is, the market is dynamic. At one point they were sitting there feeling like they had a whole bunch of wealth, and for the next decade they sat there thinking, "Shit, we're sort of stuck in this property that's underwater." And so property markets are dynamic, lending is dynamic, policies are dynamic. The macroeconomic environment is dynamic. So we need to continue to stay aware and just continue to shift through that. And there's always a way. We haven't seen anything yet that's been able to stop property investors. In fact, property investment is rising, not falling, despite all these changes in policies. So
there's sorry.
Go.
No, I was just saying, interesting question that kind of continues on that thread of dynamism and conditions not being static. So, Jared, your question about lending inside of trusts with $150,000 to spend would achieve $300,000 property work. So another change we've seen recently is self-managed super fund lending at 90% LVR, which, for fund balances of 150,000, that gets you in the market to get to a pretty reasonable price range. So, with a budget like that, you could get up near 500,000. The cash flow of the fund starts to become a challenge because the interest rates are not amazing, but just another example of constantly adapting to what conditions that you have at that point in time and what the market dictates to allow you to keep progressing forward in your portfolio.
It's super interesting that they've gone to 90. I remember when it was 60%, 70% was like, wild. Now it's 90%, which is, that's super interesting. What are the interest rates on those 90% loans?
You're talking, so it'll be close to 8 interest only.
Hectic. And for the benefit of the listeners, serviceability in your SMSF, and again, none of this is self-managed super fund advice, but I'm just highly directional question. But it's generally dictated by your super contributions, right? That's how they derive effectively the income. So if your super contributions are $2,000 a month, for example, then they will take that as your serviceable income that can service the loan which can cover the debt. Correct?
Yeah, that's correct. And the other thing which on that front, which has probably changed in the past 2 years, is even lenders out there now where they'll analyse your personal circumstances, and if you haven't been making additional super contributions to the fund and they decide that you do have the ability to make additional super contributions to the fund based off of your other personal debts, you can justify high borrowing power in super funds as well. So there's a lot more flexibility in that space.
Wow. It's almost like the lenders are trying to find more ways to lend you money.
Wow.
Yep.
It's like their businesses or something.
It's like it's their core business is selling debt, and they're trying to find any and all ways they can to say, which I think is a really interesting point for people to remember. It's like mortgage lending. It's not a public service, right? It's commercial. They're selling debt. So they're going to do everything that they can within the constraints of legal and policy and whatever their perceived risk tolerance is at the time, to sell as much debt as they can to as many people as possible, because that's how they build their business. If they were in the business of selling apples, they'd be trying to sell as many apples to as many people as possible. They're in the business of selling debt. So they're going to be the ones trying to work out how can we structure all of this kind of stuff to sell more debt, basically. So I think it's an important thing to remember. And as long as commercial banking continues to exist, they're going to continue to try and push to find ways to be able to sell more debt to individuals.
Not tulips, though, I hope. I'll fight them.
Okay.
So people watching this, we've got a bunch of finance nerds, I think, joining and watching this episode, like interested in finance strategy. Cal, I'm keen to kind of pivot the conversation to more what you're seeing in terms of finance and on the ground in your world in this year so far, particularly since we last spoke with you on the podcast.
Yeah, well, I mean, it's very interesting that Macquarie have made this stance, because the level of consumers deciding to buy properties in trusts definitely has been increasing. Like, the influencer space definitely, I would say, has had an influence on that. That would be the biggest trend if we rewind 12 months. The level of loan applications we were doing was substantially less. But I think that's probably a testament to the level of knowledge that that exists in the marketplace now, and the access to this knowledge. It can also make it confusing, but I feel like the level of intellect for property investment for your average consumer now is just it's above the level that it was 6 months ago, 12 months ago, really? which is great to see. And you see that from the level of sophistication required to put together a strategy for your average client now, or the best strategy, as I would see it, for the average client now than you would have 6 to 12 months ago. So that's probably a big piece. And then self-managed super fund lending, I would say, and I don't have any industry facts to back this up. I would say it's more just the gut feel thing. There's definitely been
make it up. Most statistics are made up anyway, so just fucking go for it.
Yeah. So it's up 15%. No.
15.4, I think.
Yeah, I think so. Yeah. Yeah, but I suppose general stance on lenders at the moment, it is a pretty lax credit environment right now. It's certainly the most lax that it's been in the last few years, and I think this Macquarie incident is probably a testament to that. Like, we've seen a very strong relaxing from banks on living expenses. Like living expenses was something, 2-3 years ago that banks were very interested in understanding your discretionary spending, perusing your bank statements. That's almost non-existent now. So things are kind of aligning with a lower interest rate environment for a freer credit market, really.
Mm-hmm.
Yeah. So, Gabby, have you got more questions on this? Because I want to talk a little bit about interest rates and the credit environment a little bit. So,
No.
The RBA, Callum, I'm not sure. Did you watch the episode we did a couple of weeks ago where we talked about M3 and everything like that? So what's super interesting to me is if we look at the conditions, inflation falling, unemployment rising, and unemployment is propped up significantly by an excess of government jobs, right? They're effectively the government deficits are running hot to try and employ more people to try and keep the unemployment number down, but it's still rising. So those indications should point to interest rates easing off, but they obviously didn't in this past week. And I honestly, I don't think they'll cut this year. I think they'll pause again in the next meet. That's what I suspect. But at the same time, private credit has been increasing. Private credit has been basically the single driver of M3 money supply growth, which has been growing at an exceptionally fast clip. So private lending, mortgages and all that kind of stuff, and other forms of private lending have been going up. So it feels like lenders are getting a little looser, for lack of a better term, or kind of like acting as though they're in a kind of looser environment in order to be able to write more loans, even though interest rates themselves aren't coming down. What are your thoughts on that?
It's interesting your point on the private credit market, and I suppose pontificating here, but I'm wondering if that's linked to how low dwelling approvals are at the moment and the opportunity that the right developers see in the housing space to bring products to the market, because the bank funded debt for large scale residential development, it's still not really there. That is still very difficult with the banks, even if we're talking about a lax credit environment. It's just interesting to me that those two factors there are aligning. I'm wondering what's your take on that, Goose?
I honestly haven't really thought about the developer piece. So I haven't really thought about the developer piece at all. I guess, I haven't really thought about the developer piece at all. I think my point of view just generally is that it appears as though you got to take into consideration that the cost of living situation as well. So the cost of living crisis is pretty high. So I don't think, and again, I don't have the data to back this up. I'd have to have a look at like loans by type and all of that kind of stuff. But I don't know necessarily that personal loans and car loans have been going through the roof, because I think cost of living has kind of kept those things off the table a little bit, and people's discretionary spending has kind of changed. Mm-hmm. And I think that I'd love you to expand a little bit on. I'm actually not sure I understand your point on the developers, because there's less building approvals and there's less building completions, which means there's less lending in the developer space, right? And if there's less lending in the developer space, yet there's still significant private credit growth. Business lending is also I don't think business lending has gone through the roof either. So I think it seems to be mostly mortgage-based lending. Now, what's interesting about that is the residential real estate market is worth 11.7 trillion now. It's at about 2.4 trillion net. Basically, the relative percentage of debt to the total market equity seems to be tracking in the same way. So it seems like the property market is growing and mortgage debt is growing, and that's kind of growing the M3 pie. So I'm not actually sure I understand your point on the developers. Do you want to expand on that a little bit?
Yeah, well, and I've just consulted the Oracle here to support my ChatGPT, who agrees with everything I say. Fantastic question, Callum.
Fantastic question.
No, it seems like there's some pretty strong linkage with the amount of private credit being used to try and get projects off the ground, and there is actually a bit of data here that supports that. And if we think about the opportunity that exists at the moment for developers that can build, given there's such a shortage of dwellings, obviously there's the cost of construction is still challenging at the moment, but that space is not being taken up by the banks at all. 75% of developers are using non-bank or private credit to get projects off the ground, which I'd be surprised if a decent chunk of that is not reflected in those numbers that you've mentioned there.
Nice. Okay, that makes tons of sense. Just for the definition of terms, when I talk about private credit on the macro sense, it's private versus public. So it's government versus non-government. So it means all, like even like Big Four bank lending is considered private lending. But it's a really interesting point. It's a really interesting point because even though there are a lot of, it's kind of like you said with Macquarie, if they step out of a certain space, it creates space for somebody else to step into it. Mm-hmm. And with the development space, been a lot of builders have been going bust and all of that kind of stuff, but also necessarily those that are well capitalized, those that can get the debt, those that can do it, can actually start to soak up that opportunity space as well. So I think it's interesting.
I think
go, Gabby.
Just quickly, so what came to mind, I think it might have popped into your mind as well, Callum, when you mentioned the loosey-goosey nature of lending recently with a lot of lenders. It does fuel obviously the additional loans that are created, but they're created out of nowhere. So that means that's effectively money creation. So if we go, anyone that listens to the show a lot has heard all of our conversations around M3 growing and money supply growing and all the trickle down effects of that happening. And this is a part of it as well. It's like the increase in loans that are being created by the demand in the space is continuing to fuel money supply. And so that's in effect fueling price growth as well.
Yeah, because every time a new dollar gets created, every other dollar is worth less, right? So nominally it pushes price up. So they create a loan, and that normally causes house prices to go up at the same time.
It's interesting with the loosey-goosey credit approach too, because you would, if you're sitting there, you might be expecting this is, happening from some of your lenders on the fringes, your non-bank lenders, but they're really operating as business as usual. The lenders that have made the biggest stance change in how free they are with credit are the major banks. Like if we talk about like Commonwealth Bank, NAB, ANZ at the moment, like the ability to get your hands on debt with those lenders and the standards by which they're assessing them, like there's a very lax level of concern there. I'd be surprised if that's not influential in the figures as well. It's just how freely they are handing out debt.
Yeah.
Nice.
Just a quick question. Do you still have this approach? I remember back in the day when we started investing in property, there was an approach of like, okay, try to get the big four, start with the big four, try and get as much as you can out of the big four and then move down the tiers. Is that still generally the strategy?
Yeah, if we can, it's interesting though, because if we talk about on the trust front, now that Macquarie have left the market, the non-bank lenders are actually cheaper than the major banks. CBA is the only lender out there that prices the same regardless, but all the other major banks, they see almost no traffic for trusts unless necessarily required because their pricing doesn't align with it. So it's kind of the balance is kind of tilted a little bit depending on what type of consumer you are. If you're looking for loans in personal names, definitely we're starting with the major banks at the top, but it's often a bit shifted if you're looking at trusts.
Interesting.
Nice. Cool. How do you see finance and finance strategies shaping up for 2026? We're near the end of the year now. Where do you see things going next year for those property investors who are starting to plan now, or they're in the process of trying to get into the market now? How do you see things changing or shaping up for next year?
Yeah, well, I mean, look, all the economic factors seem to indicate we're going to see some pretty substantial price growth, and even with the first home buyer schemes, I believe it's estimated 3 to 6% national dwelling values are expected to rise just based off of that. So, and obviously that's at the macro level, but at the micro level,
and that's on top of organic growth as well. I think it was 5 to 3 to 6, but yeah, it was like 9 to 10% in the locations where the demand would actually be, but that's on top of organic growth as well.
Yeah, and I think it's interesting because there's been numbers of conversations I've had with people where they've kind of been they were rushing to get in before October when these first home buyers incentives come out, or allowing that to permeate their decision making in terms of when they will and won't invest. So the number one thing I would say is, if you're willing and able at that moment in time, there's amazing opportunities somewhere in Australia, and you're ultimately just shooting yourself in the foot if you're waiting on some hypothesized economic circumstance to allow you to decide to invest.
yeah, let me also just play the other foot as well. It's like, yes, you should get in as soon as you can, but also like the whole like get in, buy it before October. It's like, yes, prices are going to rise because of the first home guarantee scheme. They're not suddenly going to shoot up in October. They're going to go up over the course of. So it's like if you missed October 1st, it doesn't mean that you like. It doesn't mean that you. It's like just get it. Like the modus operandi should be always move as quickly as you can. Like always, like don't wait. Just move as quickly as you can, whenever you can. If you can take action, take action. Don't wait for a catalyst. Don't get freaked out that you've missed a catalyst. Don't, because just in the same way that people can try and wait for, I don't know, interest rates to drop or something, or they could try and get in before something happens. Like, none of it matters on the macro. You should just move. If you can take action, take action. If you can't take action and you miss some fictional or kind of like psychological moment, it doesn't matter because you couldn't have taken action anyway. But if you're constantly taking action as soon as you can take action, then you know in yourself that you've always made the best of the opportunity that you've got. You never have to, stay awake at night thinking, oh, what if I just got in a bit earlier? What if if you always just take action as soon as you can take action, you'd never have to live with the regret. And you're right in the sense there's always going to be somewhere that's on the boil that's going to be a great place to invest. There's 15,363 towns and suburbs in Australia. There's always somewhere that is good to invest. So if you're always just taking action as soon as you can take action, then you never have to live with regret.
Can we fact check that number? 15,236?
363, 15,363.
Been saying it in a while.
Yeah.
15,000. Oh, let me fact check it. It's 15. I'm pretty sure it's 15,003. It was it was a few less, and then in the last census they increased the.
I think you're missing north, east, west, Clyde. I think you've missed that one.
Classic.
How many towns and suburbs in Australia? I'm gonna fact check this.
You can fact check yourself. It's such an interesting space, right? I think like we've been in this industry a long time now, and everyone is always looking for reasons to not move forward. Like there's always, I don't like saying the word excuses, but we are emotional beings. We like to think as investors we're not, but we do have a tendency to let emotions kind of dictate how we feel about a situation and find reasons why we can't keep moving forward. And it's been that way forever, as long as we've been in this space, that there's always something that people are like, oh, I can't do that now. So like the first home guarantee scheme, I heard a lot of people say like, oh, well, it's happened now, so I'm not going to buy it. It's like, what? Yeah. Why? It's not. It's a tiny little data point that just like feeds a little bit into your strategy, and you adapt. You don't go, well, I can't do it now.
Yeah, I think it's a really interesting point, because I think most investors invest with the wrong time horizon. So what they're looking for is things that are right in front of them, whereas in fact they should be thinking about, where is this asset going to be in the next 2 years, 3 years, 5 years, 10 years. Like, look, different theses will give you different timelines. But this goes not just for real estate. This goes for all types of investing. Like if you're investing in Bitcoin, I don't know, like it's gone to $125,000 down to $100,000 and then it's got all over the place this year. It's like, all right, that's fine. But are you investing based on where the price is going to be in the next month, or in the next week, or in the next 2 months? Because if you are, then what you are is you're a short-term trader. In real estate, you can't be a short-term trader. You have to be thinking, well, you want to hold it at least 12 months. You probably want to hold it at least 18 months. So then you should be thinking not what is happening this month, but actually where is this market or this asset going to be in the next 18 months, minimum, probably 3 years to 5 years. So we're at the end of 2025 now. So really, when you're investing in a market, what you're actually saying is, where do I think this market is going to be in 2028, 2029, or 2030? That's what you should be thinking about, not what is the lending policy today? What is the interest rate going to be? I wonder if they're going to cut interest rates next month or not. It's like, well, they could cut interest rates 10 times and then raise them 10 times between now and 2028 and 2030. You wouldn't know, who knows? Who knows what's going to happen? It doesn't really, so really taking a different perspective and a different view, actually, I find it so much easier. We've had a lot of success in investing. And that's because I'm always I personally recognize that particularly in other in real estate, you're always taking a longer term view anyway. But even in other asset classes, I don't pretend to know where the price is going to be next week, next month, or even in 3 months' time. I just develop a thesis on where I think something is going to go over the next 3 to 5 years, and it's way easier because it's way easier to be like, okay, is it going to be at least like double? Like you don't even have to be that smart. You can be like, okay, do I think this is going to double in the next 3 to 5 years? That's a pretty easy, like you can pretty easily ascertain something like that. Then you only need to be directionally correct rather than trying to trade on individual price, which is also why when you get into markets, it's like I've seen property investors lose out on very good investments because they were trying to negotiate $5,000 off on a building and pest inspection or something like that, and the vendor wouldn't negotiate down, and so they go, fuck it, we'll pass in the contract. And then subsequently that property has gone on to double in 12 or 18 months. And they missed out on that because they were nitpicking over $5,000. Or they're like, I looked up the property value on realestate.com.au and it said the property value is 475 and the vendor was asking 480. I think it's overvalued. It's like,
yeah.
If it's going to go to 900, do you really care whether you're buying it for 475 or 480? Like, do you actually care? Do you care if you're buying it at 500? Like, if you had a high degree of confidence that property was going to be worth 900 in 3 to 5 years' time, why wouldn't you just pay 500 for it and just get it done? Like, why not? Like, because in the grand scheme of things, it's not going to matter that much.
Yeah.
And so I think the short term thinking is critical. Go on.
Sorry, I didn't mean to butt in there. I was just
remembering. No, go for it. I like it.
Go for it. I was just remembering our client Jay. I hope he doesn't mind me mentioning his name, but we helped him to sell property recently, and I was just reviewing the portfolio and seeing the performance. And you and I were talking because I think you may have found his property for him in like
his first one. Yeah.
And we were talking about because you were like, we're just looking at the results that he's made. I think he's made $630,000 or something. Profit, like end of the day. And you were talking about remembering going through that process with him at the start of him not really wanting to buy that property because it had some stumping issues. Well, I can't remember what that cost.
Let me be honest. It was a bit of a clunker, right? It was a bit of a clunker. Yeah. It was a bit of a and it had like, I don't know, 11 or 15 rotted stumps or something, like, like it was
not great, but
which is not great, but we negotiated the price off. We negotiated enough of the price off that he could replace the stumps, right? So however much and correct, Erica, even clunkers will appreciate.
Appreciate
this property, Gabby, I'm not sure if you've got the stats there for that property, but we bought it for $275, I think, and then we sold it for like $640,000 or something like that. And the funny thing is, we negotiated enough of the price off for him to be able to replace the stumps. And then 5 years later, when he sold the property, he told me he never ended up replacing the stumps because he never actually needed to replace the stumps. Like, it just never became a big enough issue. And then he sold the property in the same, like he sold the property with the same stumps that so he just got, and if he freaked out about that too much, he wouldn't have bought. By the way, he also was the one who was going unconditional right when COVID was hitting as well. So hats off to Jay for being a brave investor, and that bravery made him a lot of money.
Yeah.
So
bought for $275, sold for $645.
Yeah, bought for $275, sold for $645. And if I showed you a photo of it, if I showed most property investors a photo of it, they would be like, "Oh, I don't know, it looks a bit rough." And correct, but I was 100% convinced because I actually helped him buy that personally.
Jared.
And
Jared just said, "Lol, I got one that needed restumping. It's also done 36% in 12 months."
Exactly right. So
this is again, it's this mindset. Again, we're not trying to like. Properties always have issues. Yeah, properties always have issues. It shouldn't be a reason to not buy the property. It's just like we have a tendency to want things to be perfect as humans. It's not going to be perfect. If you have people like Dashdot on your team that are saying this is a very good opportunity in a very good location that is likely to boom, not boom, I don't like saying the word boom, but like good growth is coming. Don't let these little things stop you from getting results like what Jared's got or what Jay's got or those kind of things.
Yeah.
Well,
even on a personal front, we bought an old clunker, but we knew it was under market value.
Old clunker. Yep.
And 2 months after we bought it, we had to replace the roof. That was something we had to replace the roof 2 months after we bought it. Oh no. Oh,
You'd rather
so
not. Again, you'd rather not.
Sure, you'd
but
rather
it's not
you'd
reason
rather not. But that property fueled so much of our property portfolio. It performed exceptionally well. It was an absolute hooner, and we still own that property today. And it was like, okay, look, we like a year later we'd forgotten we'd even spent the money on the roof. It didn't really matter. Who cared, right? We'd made enough money. So I think people can get caught up on these things. Short-term things, sensationalized media. Oh, Macquarie's ending property investing. Any of this kind of stuff. It's like keep calm and carry on, as they say. So cool. Well, I think that's feels like that's a wrap, Gabby.
Callum, is there anything else you wanted to share? Anything else we haven't covered? Anything to do with finance or the space or interest rates or anything that you want to share?
No, I think more than ever, it just reinforces the value of having the right team on your side, from broker to property buying services. It always been all-encompassing service to allow you to navigate through these complex market conditions. So keep that in mind, team.
Great.
Nice.
I'll do just for the sake of it, I'll do a shameless plug. So Dashdot's portfolio growth system. If you do work with Dashdot, we have a 4-stage process. Dashdot Finance and Callum's amazing team is part of that. So if you do come and work with us to grow your property portfolio, you get to work with Callum and the team. But you don't have to work with Dashdot Finance. You can, come along and chat with the team if you are looking for a finance strategy, if you want to pick Callum's brain. Again, we've got a really awesome team now who all the ways that Callum thinks about finance strategy, and if you need any guidance on how do I build my strategy and adapt in this environment, Dashdot Finance are a really solid team to give you guidance on that. I will put a link to book in a chat in the show notes and on the YouTube description. If you do have questions that we didn't cover, if they come up and you're watching this on YouTube, just leave a comment on the YouTube video. Like I said, I will wrangle Callum to jump in and respond to those when he can. Otherwise, I think that's all.
I just want to make an additional comment on the portfolio growth system because I think it's really relevant to just expand on that a little bit further. So Dashdot's portfolio growth system has got 4 parts: plan, finance, acquire, and optimize. And we talked about a lot of things in this episode that kind of touch on all of those aspects. So number one, if you want to grow a property portfolio, you need to have a plan. You need to be thinking about where you're trying to go before you start off. So that's an essential piece of the puzzle. Obviously, we spoke a lot about finance. That's the second part of the portfolio growth system in this episode. Then acquiring, we talked about, we talked a bit about that in this episode too, finding the right property in the right place at the right time, knowing how to select the right assets that are going to help you to grow and achieve your goals is essential. But then the fourth part, optimize. We talked about the fact that the real estate market is dynamic. We talked about the fact that you need to continuously adapt and evolve and change and shift, and things are going to, this is why you need to continuously optimize your property portfolio. Now, statistically speaking, Dashdot has been able to outperform the market consistently over the last 6-7 years, consistently. Eventually all suburbs revert to the mean. So how do you know when to enter into the right suburbs at the right time, exit the right suburbs at the right time, how to continue to evolve your portfolio strategy based on current financing conditions? These are all the things that happen when you continue to optimize your portfolio. That's why our clients end up working with us for life, because they have a flywheel that helps them continue to grow and build wealth over time. So I think it's a really essential and really important part. It's like you have the right team, but you got to have a portfolio growth system if you want to succeed as well. So that's just my final point on that.
And we do it because we don't like seeing people get stuck. And this is what, the whole system was built because, I can't remember the stats. Goose, you would know these stats, but 91% of
90% of property investors never get past 2. So 91. Sorry,
71 and 90.
71 and 90. 71% of property investors get stuck at 1 property, and another 19% get to 2. But 90% of property investors get stuck at 2 properties. So.
Yeah, and that's a real shame because it's come from a lack of strategy and a lack of support and insights into how they can make sure that doesn't happen. And so that's why we've created it. We just want people to create the lives that they've always wanted to create. And part of that is the wealth side of things. And if you can tap into a system that will help you to do that, then why would you not do that? So that's why we basically created this. And that is all. Cal, thanks for joining us this week.
Thanks, Sam.
Thanks.
Thanks, Thanks for all of you who joined us live. See you guys out there. And remember, if you didn't watch this live, leave a comment on the video. We'll get back to you as well. Bye for now.
See ya.